All right, let's talk about investing. But we're not going to start with a bunch of complicated charts or Wall Street jargon. Nope. We're going to start with the single most unpredictable and, frankly, the most important factor in your financial success, you. Because it turns out the biggest hurdle isn't the market itself, it's what's going on inside our own heads.
So let me just ask you this. What if I told you that the secret to getting ahead financially has less to do with being a stock-picking genius and everything to do with understanding the sneaky mental traps that we're all hardwired with? That's the big idea we're going to unpack today. So here's the game plan. First, we'll look at those mental traps I mentioned, the things that can trip us up. Then, we'll talk about our secret weapon, the incredible power of compounding. After that, we get super practical. We'll cover the basic tools, how to put them together in a portfolio, and then the exact steps to actually get started.
Okay, let's dive right into section 1. Our brains are amazing, right? But they didn't exactly evolve to play the stock market. To deal with the world, they use all these little mental shortcuts, which are great for, not getting eaten by a tiger, but they can lead to some really bad financial decisions. Let's look at a couple of the big ones. First up, we've got something called confirmation bias. So, let's say you buy a stock in a company you just love. What this bias does is it makes you automatically look for news that says, "See, you were right." And you just kinda ignore the articles that are screaming about new problems or bad sales. You're basically creating your own little echo chamber to feel good about your decision. And that is a dangerous game.
And then there's this one, loss aversion. Psychologically, it's just a fact. Losing $100 feels way worse than the pleasure of gaining $100. And this leads to a huge investing mistake. People hold on to a stock that's losing money for way too long. They just keep hoping it'll bounce back because selling it would mean they have to face that painful feeling of loss. It's a totally emotional move, not a logical one at all.
So, if our own brains are kind of wired to mess things up, how do we fight back? Well, you don't fight alone. You find an ally. A force that is so powerful it can steamroll right over our worst instincts. And that ally, my friends, is the simple, beautiful, unstoppable magic of compounding.
And hey, you don't have to take my word for it. Albert Einstein himself supposedly called it one of the greatest discoveries ever. And this isn't some high-level complicated math. It's just a simple idea that can completely change your financial future once you really get how it works.
This graph right here shows it all. Look at Pam and Sam. Pam puts $15,000 into an investment when she's 25. Sam invests the exact same amount, but he waits 10 years until he's 35. Now let's zoom forward to when they're both 50. I mean, look at that gap. Pam has over $23,000 more than Sam. Why? It's not because she was smarter or picked better stocks. It's because she gave her money a 10-year head start. Her money started earning money, and then that money started earning even more money. That is the magic. Okay, so now we know our greatest ally is time. But how do we actually put that time to good use? Well, we need the right tools. And honestly, it's a lot less complicated than most people think. It really just boils down to 3 main things. So here they are, the big 3. Stocks. You're buying a tiny piece of a business. It's higher risk, but also has the potential for much higher returns. Bonds. You're basically acting like the bank, lending money to a company or a government, and they pay you interest. It's lower risk and, you guessed it, lower returns. And mutual funds? Just think of them as a pre-made basket that holds a whole bunch of stocks and bonds all mixed together. And that idea of a basket of different things brings us to maybe the most crucial concept of all, diversification. You've heard it a million times. Don't put all your eggs in one basket. Well, there's a reason for that. By spreading your money out, you make sure that if one of your investments has a really bad day, it doesn't drag your whole entire portfolio down with it. It's your #1 defense against the unexpected. Okay, so we've got our tools and we've got our main defensive strategy. So how do we actually put this stuff together? This is where we start building a portfolio that's actually designed for you and your own life.
Just look at these 2 examples. On the left, you've got a conservative portfolio. See how it's mostly made up of those safer bonds? That might be for someone who's getting close to retirement. But on the right, it's a more aggressive portfolio, way more stocks, because it's aiming for higher growth. That's for someone younger, someone who has decades to invest, someone like Pam. The big takeaway here is that it's not about finding the best investment, it's about finding the right mix of investments for your goals and your timeline.
So we've covered the why and the what. And now we're at the final, and let's be honest, the most important part, the how. This is where all this theory turns into action. Let's make this real.
So the very first real-world step is to open a brokerage account. That's just the place where you'll actually buy and sell your investments. But before you just pick one at random, just run through this little checklist. Are the fees low? Do you need a ton of money just to open the account? Do they offer the things you actually want to invest in? Spending just a little bit of time on this now can save you a whole lot of money and headaches down the road.
Look, if this all still feels like a little much, don't worry. I get it. There's a beautifully simple strategy to get started, and it's called passive investing. Instead of trying to be a stock-picking wizard, you can buy one single thing called an index fund. For example, an S&P 500 index fund just tracks the 500 biggest companies in the US. With one single purchase, you own a tiny sliver of all of them. Bam! You're instantly diversified, it's super low cost, and you just let the market do the heavy lifting for you. It's a seriously powerful way to start.
So we kind of end right back where we started. The biggest thing holding most people back isn't a lack of knowledge, it's just that little hesitation to take the first step. We've seen that the enemy can be our own brain, but our greatest friend is time. You don't need to be an expert to get in the game, you just have to get in the game. So the only real question left is, what's your first move going to be?